Welcome to The Explainer. Today, we're cracking open the playbook of the absolute top-tier consultants. Ever wonder how they manage those massive, multi-million-dollar portfolios? Well, we're about to break down the exact frameworks they use to build and protect that kind of wealth. Okay, let's just dive right in. Imagine this. A new client walks through the door. They've got $50 million. What's the plan? Now, managing this level of wealth, it's not about picking hot stocks. No, it's about solving a fundamental conflict that sits at the very heart of investing for the ultra-wealthy. You see, high net worth individuals, what we call HNIs, they face this really unique challenge. And this challenge, it's going to define every single decision we make from here on out. It's a constant push and pull between two powerful and often competing goals. So on one side, you've got this mandate for capital preservation. Think about, old family money, where the number one goal is just protecting that legacy for the next generation and the one after that. But on the other side, you've got these new wealth creators, maybe a tech founder who just had a big exit, and they're often looking for really high growth opportunities to aggressively build on their new fortune. Two very different mindsets. And here's the absolute crucial point. For HNIs, whose money is almost always in taxable accounts, that big pre-tax return number you see on a statement, it's kind of just noise. The only number that truly matters is what's left after everyone gets their cut, especially the taxman. All right, let's get into the strategy. So to manage that central conflict we talked about, that tension between preservation and growth, a really sophisticated portfolio, it has to operate on two timelines at the same time. Think of it as a two-speed approach. Okay, so the first speed is your strategic asset allocation, or SAA. The best analogy? It's like planning the route for a huge cross-country road trip before you even get in the car. It's your steady, long-term direction. And this foundational plan, this is what's going to drive the vast majority of your returns over the long haul. And the second speed? That's your tactical asset allocation, or TAA. So, if the SAA is your big picture roadmap, the TAA is like using your GPS to navigate around a sudden traffic jam or take a scenic detour. It's the flexible, short-term moves that let you exploit opportunities and try to generate alpha, those juicy returns above and beyond what the market is giving you. So that's the theory. But how do we actually build this two-speed portfolio? Well, the industry standard is this really elegant, really powerful structure called the core satellite approach. And honestly, this is the architectural blueprint for pretty much every major private wealth portfolio out there. And this visual just lays it out perfectly, right? The core, that's the huge chunk of the portfolio. We're talking 70, maybe 80%, and it's all about stability. Then you've got that smaller satellite portion. That's where we get aggressive. That's built for speed. Let's use another analogy. Think of the core as your car's super reliable engine. It's usually built with really low-cost, tax-efficient index funds that just give you broad market exposure, what we call beta. The satellites, on the other hand, those are the turbochargers. This is where you get tactical with actively managed funds, thematic bets, and all designed to hunt for that alpha and beat the market. Okay, this next part, this is where we separate the amateurs from the pros. If you really want to add value as a consultant, there are two concepts that are just absolutely crucial to get right. Alternatives, and, maybe even more importantly, something called asset location. Let's start with alternatives. For the wealthiest of the wealthy, the ultra-high net worth crowd, private markets aren't some tiny speculative play. Nope. On average, they allocate a combined 25% of their entire portfolio to private equity and private debt. And just look at the scale here. That 25% is a massive commitment. It's not a footnote. It typically breaks down into a really hefty 20% chunk in private equity and another 5% in private debt. So why so much? Because this allocation is a huge differentiator. It gives you access to growth and diversification that you just cannot find in the public markets. But the real aha moments, the thing that will make you a star consultant, comes from knowing where to put these assets. This is called asset location. It's not what you own, it's which account you own it in. And the pros? They call this the very first line of defense in the war against taxes. And this matrix, this is basically your cheat sheet for winning that war. Just look at it. Assets that are really tax inefficient, like private credit, which gets taxed at high ordinary income rates, they go into tax-sheltered accounts. But the really tax-efficient assets, like private equity with its long-term capital gains, well, those are best placed in your regular taxable accounts. Getting this right is a complete game changer for your clients' final returns. It's huge. So, for all you aspiring consultants, all you MBAs out there, let's boil this all down into what you really need to know for that next big interview or client meeting. This is your prep sheet to sound like you've been doing this for years.
Just remember these three pillars. The core satellite model, that's the how. It's how you build the portfolio. Private markets, that's a key part of what goes inside it. And maximizing after-tax returns with smart asset location, that's the why. That's the whole point of the game.
And I can pretty much guarantee you're going to get asked these questions, so be ready. The good news is this explainer has given you the whole framework, the analogies, the logic, everything you need to give a really clear, really confident answer to every single one of them. You know, the world of wealth management can seem unbelievably complex from the outside. But as we've just seen, it's really built on these logical, powerful, and honestly kind of elegant principles. Mastering them isn't just about acing an interview. It's the first and most important step to providing real, tangible value to your future clients.